So as Amy mentioned, and you all know, PWMA has worked with KPMG to produce an annual Hong Kong private wealth management report, which aims to provide a view of the current industry landscape, as well as the growth outlook for the next 5 years. So that report's based on an online survey conducted by KPMG. And our next speaker, Mr. Paul McSheaffrey, Head of Banking and Capital Markets of KPMG China, is going to present the key findings of that survey and also the highlights of the just released KPMG white paper. So the white paper focuses on these key recommendations to move the industry forward. Let's welcome Paul now to the stage as he brings all that to us. Thank you.
Good morning, ladies and gentlemen. As Karen said, I'm here to talk about two documents that we've been working on with the PWMA over the last few months, the annual survey and report, but also the white paper that looks forward into the future of the industry and what's needed to take it forward. I'd like to take this chance just to thank Amy, the ExCo, Peter and his team, and all of you in the industry who helped participate and support us during this survey. We do appreciate your help. When I step back and take stock of what we heard and saw from the survey, from the interviews we conducted, I came to the conclusion that overall, in Hong Kong, the private wealth management industry is in a very strong position, but there is clearly action that needs to be taken in order to move it forward and for it to continue to be a leading global wealth management hub of the future. That is the vision and that is the aim. And it needs the people in this room to make sure that you're talking about these actions and taking them forward. And hopefully I'll give you a sense today of what those actions are. So what I'm going to talk through this morning for about 20 minutes is just a little bit of the findings from the survey, what kind of got us to that view of the industry is in a strong position. And then I'm going to introduce some of the themes from the survey and how that relates to the recommendations to take the industry forward. But let's just stop and look at some of the key findings from the survey. Firstly, and Amy mentioned this already, we found that assets under management had hit $1 trillion US. That represents about a third of all the assets under management across wealth and asset management in Hong Kong in total. It's a really strong performance. What we've also seen is that the compound growth rate of that assets under management since 2015 has been 20%. And that's expected to continue. When we asked respondents, what did they expect the growth of asset management over the next 5 years, the most common response was 10 to 20%. That means in 5 years, we could easily double AUM. In 2023, I could be up here talking about $2 trillion US of assets under management. It's a significant business and a significant global wealth management hub. 57% of the assets under management are offshore sourced, and that is going to continue to increase. We've seen that the number of high net worth individuals in Asia is growing at 15% a year. In the survey, respondents said they expect the share of mainland China sourced AUM to rise from approximately a third to nearly a half, to 49%. We're going to see a significant growth in continuing increase in the proportion of AUM which is offshore sourced. In people, there's 3,800 approximately client-facing professionals. And that's been increased 12% since 2015. I'll come into a little bit more on some of the challenges on talent and some of the recommendations to move it forward, but clearly there is a challenge there. As part of the white paper, KPMG also researched the economic impact of the private wealth management industry to Hong Kong. And Amy talked a little bit about this, but it is a significant industry. 25 to 30 billion Hong Kong dollars contribution to GDP. Another 1.5 to 2 billion US dollars in terms of just your clients coming to Hong Kong, visiting staying in hotels, shopping, going to restaurants. As well as that, we estimate approximately 10,000 direct jobs and 5,000 indirect jobs because of the private wealth management industry. It is a significant industry. And so I think from that, we can see there has been a great performance. However, the industry can't rest on its laurels, and we need to look at what needs to be done going forward to move the industry forward. And so what we set out in the white paper was this vision. A vision for Hong Kong to be a leading global wealth management hub, with a leading share of assets sourced from across the world, and being recognised as a centre for product and service innovation. And the 4 themes that came out of the survey were around growing the market, regulation, talent, and technology. And I'll talk about each of those and some of the recommendations in the white paper as well. But in talking to ExCo and as we went through this, it was clear there were 3 key priorities that would be really important and would make a significant difference to the industry in terms of moving it forward. Firstly, attracting more family offices to Hong Kong. Secondly, enhancing the access to mainland China. And thirdly, streamlining regulation. And each of those is within the recommendations, and I'll talk about those as we go through. So growing the market. All of the respondents to the survey saw significant opportunities to grow the market, and in particular in 2 areas, family offices and China. Family offices are expected to be increasingly important. We're seeing some key trends, more formal, professional family offices. We're also seeing global family offices starting to be more interested in Asian assets and investing in Asia and setting up offices here. However, we should all be aware there is very, very strong competition from other wealth management centres for family offices, notably Singapore, and that came out through the interviews we conducted as part of the white paper. But we believe there's a lot that can be done around family offices, and 3 things in particular, and these are white paper recommendations. Firstly, promotion. Promoting Hong Kong more actively, more proactively as a wealth management centre. This would need to be a regulator or government-led effort. It would market Hong Kong. It would prepare materials on the benefits of Hong Kong. They would run seminars, roadshows around the world to attract people to come to Hong Kong. And they would sit in with interested parties to get them to commit to coming to Hong Kong. There would clearly need to be some strong KPIs in place to make sure that we did see the results of this effort, that there was net new money arising, that assets under management were growing. But that is a key recommendation for us. And somewhat related to that, following on, is facilitating the setup of the family offices. Once we've got them to commit to come to Hong Kong, we need to make it easy for them to set up. We can't just say, well, thanks for coming, you're on your own now. So we envisage an investment office liaison centre, similar to what is already out there for fintechs, that will help family offices when they come to Hong Kong. It will help talk them through licensing process, business registration, immigration if that's appropriate. We'll introduce them to service providers, to PWMA institutions, so they can get set up quickly and easily, and word starts to get out that Hong Kong is an easy place to do business. The third area to attract family offices is around setting the right tax environment. The real objective here is to make sure we have a level playing field with other wealth management centres. Tax policy is an important tool in attracting and encouraging business to Hong Kong, and is something that the Hong Kong government has used in the past, and I'm sure will continue to use. And we think it's appropriate here for the wealth management industry. A couple of key recommendations here are making sure that the tax rules are set such that they don't expose offshore investments to tax. And we're also suggesting and recommending a reform and clarification of how trusts are taxed, to ensure that there's clarity there and people can start to use Hong Kong domiciled trusts more frequently. The second significant growth area around growing the market is mainland China. Respondents expect nearly half of the AUM in 2023, 5 years from now, to come from mainland China. And it was the most popular source of growth in the survey. What we're recommending is a mutual wealth management scheme in the Greater Bay Area. This would be reciprocal, it would clearly take time, and would have many stages. The first stage would be to allow RMs based in Hong Kong to freely go into the Greater Bay Area to target new customers, to meet and solicit sales from their existing customers. But that would be a reciprocal right and would apply to institutions in the Greater Bay Area as well. Then over time, through discussions and consultation with stakeholders, we're recommending the setup of a pilot scheme which would be controlled to allow cross-border fund flows into private wealth management accounts in Hong Kong. And over time, as people got used to that, as we saw the success of that scheme, it could be expanded out into a wider scheme. Moving to the second theme, an area from the survey, and the third priority, the key priority that I mentioned earlier, regulation. Regulation is driving higher costs and poorer client experience. That was the feedback we received during our survey. When we surveyed people about what are the top 3 reg concerns, 100% of you said sales and suitability practices is one of the top 3 concerns. Every institution that responded to the survey had that as one of their top 3 concerns. And we found during our interviews that many people compared Hong Kong unfavourably to Singapore. And some examples. One institution had looked at the number of steps to complete a transaction in Singapore and Hong Kong. It was 18 steps in Singapore to 28 in Hong Kong. We looked at the number of disclosure, and it's in the white paper, the number of things that are required to be disclosed to a customer at point of sale. 7 in Singapore versus 10 in Hong Kong. So clearly there is a demand and a need from the people in this room for something to happen on regulation. And the primary recommendation is a private wealth management code of conduct, something that has been talked about before. This would need to maintain current levels of investor protection. It would be consistent with principles in the banking and SSC codes of conduct, but crucially would look to streamline all of the various guidelines and circulars that exist into one holistic document that is easier to follow and is suitable for private wealth management customers, not necessarily other customers. It would replace, not add to the existing guidelines and circulars. Now, this is going to require close work over a period of time with the regulators, and the regulators will need to endorse it. But we believe it's an achievable and worthwhile recommendation to follow. The third theme in the survey that came through was talent. People are at the heart of the industry and are key to success, but there is clearly a lot of change going on. And the key finding was talent is the biggest supply-side constraint in the industry. 66% of respondents identified that as their biggest supply-side constraint. Now, that was mainly around relationship managers and client-facing personnel, but actually also covered operation staff, risk staff, compliance staff. In all roles, there was a constraint around talent. And at the same time, people talked to us about the need for an RM's role to change, for an RM to become the conductor, the connector, the coordinator. Not someone who necessarily deals with sales, but the person who orchestrates all of the activities of the institution and brings them to the client. So it's a bit of a role change. You've also got technology impacting the role. And it was clear from the survey that many respondents expected technology to take away many of the administrative, operational aspects of an RM's role and provide more time, free up time to spend with clients. So there's a lot going on for an RM at the moment, and a lot of the role is changing. Another finding we had is around hiring trends, and hiring trends need to change. The most popular source of recruitment by far was other peer institutions. And if firms are recruiting from other peer institutions, you're not necessarily growing the talent pie. I talked earlier about how in 5 years' time, I could be standing here talking about AUM doubling. RM numbers might not need to double in 5 years, but there will need to be a significant increase, and that's not going to happen if people continue to just hire from peer institutions. In the white paper, we looked very closely at how we can encourage lateral hires from other industries to come into the private wealth management industry. And one of our recommendations is around reforming the training subsidy and access to existing training funds under the existing WAM pilot scheme in order to make it easier for for lateral hires from other industries to come into the private wealth management industry. And also on talent, we looked at the need to continue to attract people from other centres to come to Hong Kong. And we're recommending the setup of a postgraduate degree in Hong Kong. That would encourage talent from other centres, be it China, Asia, or the rest of the world, to come to Hong Kong to continue their learning and development and subsequently to work here in Hong Kong. And that postgraduate degree would be this focal centre for innovation on product and service going forward. The last theme we had was around technology. One of the interesting things I found when I looked at the survey was more than 50% of the respondents expect a significant increase in transactions being conducted digitally. At the same time, more than 50% of respondents also didn't think their current digital offering met client expectations. That tells me there is clearly still a lot of work to do around technology and the technology offering in the industry to clients. And there were 3 areas in particular that people were looking at in terms of using and enhancing technology going forward. Firstly, providing more value add to customers, whether it's through aggregation tools, portfolio simulation tools, better access to research and product ideas. That was the first area. The second area institutions were looking at was how can we do more online digital selling of more complex products. And the last area was, and I mentioned this before, looking at operational efficiency. How can we make it easier for RMs? That was the third area where people really wanted to see technology make a difference. So, I'd like to leave you with some key takeaways from the survey and the white paper and some key messages. Firstly, this is a key industry for Hong Kong. GDP, $25 to $30 billion, 15,000 jobs. It is a key industry for Hong Kong. The industry is in a strong position. $1 trillion US dollars of assets under management. Hong Kong is an established financial centre that people know and trust, and it is the gateway to mainland China where there is significant wealth creation. Macro trends as well are also favouring Hong Kong. As I said before, we're seeing significant wealth creation actually, not just in mainland China, but across Asia. More wealth needs to be managed. But also Asia is becoming an increasingly important investment destination for wealth, for family offices and other high net worth individuals in other locations who may want to come to Hong Kong because of that. And then lastly, we've set out in the white paper some clear recommendations to help move the industry forward. It's about attracting family offices, promotion of them, making sure we're encouraging people to come to Hong Kong proactively, and then setting the right tax environment. It's enhancing our connectivity to China and the Greater Bay Area in particular through that mutual wealth management scheme. And lastly, it's regulation. It's moving to a private wealth management code of conduct, which is easier to use and more streamlined for people to follow. So those are the key recommendations to move the industry forward. And with that, ladies and gentlemen, it finishes the formal part of the presentation. Thank you very much.
Thank you very much, Paul, for presenting all that research that you did for us. We do have some Q&A. Actually, we have some questions that were submitted earlier. So let's just go through some of those. First one is simply, what are Hong Kong's advantages as a global wealth management hub?
Sure. I think I talked about some of them before, but I think it's one, its location. It is in Asia, it is the gateway to mainland China, so it is ideally centred and situated to capture a lot of the wealth creation that's happening in the world. And the trend in wealth creation that we're seeing is around much more wealth creation in Asia. In addition to that, Hong Kong's already an established financial centre. It has all the infrastructure, the professional service providers, and it has a lot of the product providers, whether it's investment banks, asset managers. It's got a vibrant equity capital market, increasingly focused on debt capital markets as well, so private equity. There's lots of product providers that are coming to Hong Kong as well that make it a good, it's got those advantages as well.
Okay, now you did speak about talent as being a bottleneck, a bit of an issue. It's not just the private wealth management industry that faces this. So what more can be done to grow that talent pool?
So I think you need to split into two things. There's what the government and regulators can do to help the industry. And I think we talked about those two recommendations around reforming access to training for people to retrain to come and join the wealth management industry, and also the postgraduate degree. But one of the notable things in some of the interviews, in particular one we did, was talking about undergraduates. There isn't necessarily a strong view on campuses around, undergraduates, PWM as a career. And I think that's one of the things, getting people excited about PWM as a career. I think the apprenticeship scheme that is there is a great start to that. And that needs to continue to grow, and people need to see role models who will come through and grow your own. But it really needs to be a mixture. You can't just rely on graduates on your own. You need to have that cross lateral hires coming in from other industries and people retraining.
So when you talk about undergraduates, do you mean sort of just raising the awareness that here, this is another career path apart from investment banking?
Yeah, and the apprenticeship program allows people to come in and see what it's like and then move through the ranks. But it does take time. We recognize it also takes time for people to become seasoned and experienced and ready to go and stand in front of a client. But there is an element of you need to do a little bit of everything. You need to hire people from other industries, you probably need to hire people from other firms, and you probably need to grow your own. But it was clear that in campuses, people looked at accountancy firms, they looked at investment banks. They didn't really think about private wealth management.
I know this because I have a son who wants to be an investment banker.
Not many people want to be investment bankers.
That's true. I don't know why he wants to do that. But it's true, there is not that really, and this is in the US, and even there's not that awareness that this is a career you could actually start in. Just moving on to the next question then. The code of conduct, what sort of benefits would that bring?
When we did a lot of the interviews, and clearly the survey results speak for themselves, 100% of you think that sales and suitability practice in particular, and that would be a small part of the code of conduct, but 100% of you think that's one of your top 3 reg concerns. And clearly people talked to us about poorer client experience. It was a struggle to do business. So I think what's clear is there are 2 regulators, there's lots of guidance notes. That just creates complexity and makes it difficult for people to therefore design processes that help the client experience, but also ensure that investor protection regulations are met. Having one private wealth management code of conduct that everyone has to follow is just one set of rules that the industry can work on and agree with regulators. We just make that process so much easier and allow you a voice at the table to actually kind of say, this is how we want it to look like, but still maintain that investor protection.
All right. What do you think that the private wealth management industry growth will end up being faster in Hong Kong rather than Singapore? And if so, why?
As long as no one's going to come back in 12 months and ask me about why my prediction didn't come through. Look, I think there's a lot of natural advantages to Hong Kong, but Singapore has been very competitive. And I think if Hong Kong, because it's got its natural advantages, it hasn't, and this is the promotion recommendation we made, Hong Kong needs to be more proactive in marketing itself as this private wealth management centre. And I think that's one of the recommendations we actually think is easier to do and can be done in a quick timeline. And so if that happens, I would actually be pretty confident that Hong Kong would grow quicker than Singapore, because being proactive and attracting people, together with the natural advantages it has around gateway to China, it's to my mind a stronger financial centre than Singapore, would allow it to grow quicker. But the key point there is that promotion needs to happen.
And is there anything preventing that from happening?
People need to implement the recommendation in the white paper. I think that is the key thing.
There we go. That's good. All right. Well, Paul, thanks so much for presenting your recommendations and the findings. It's really great to know firsthand, what you found. So, ladies and gentlemen, can we please have a round of applause for Paul McSheaffrey?
Thank you.